Most traders use the same stop loss distance on every trade. That is, the same number of pips. Slow market or a volatile index, it doesn't matter. And the market clips their stop loss and runs to their take profit without them. I blew my first trading account using fixed 20 to 30 pip stops on everything. It took me 4 years to find the 5 mechanical errors draining my capital, and 1 fix worked overnight. Each one comes to a single yes or no question, and the first error is probably in your last trade. A market that moves 80 pips per day and a market that moves 300 pips per day don't need the same protection. But most traders set the exact 30 pip stop on both. For decades, doctors prescribed warfarin, a common blood thinner, at the same standard dose for every patient. Some patients nearly bled to death because their body processed the drug too slowly. Others formed clots because the drug barely registered. Same dose, opposite results. The fix was personalized dosing calibrated to each patient's biology. Put a 30 pip stop on a market that moves 80 pips per day, and the market's normal breathing room is nearly 3 times wider than your protection. And if you trade Forex and commodities with the same average true range multiplier, you are making the same mistake twice, because those asset classes move at different speeds. Your stop loss distance is the noise. Mistake number 1. Replace your fixed pip number with a 10-period average true range. Open the ATR indicator, read the current daily range, and multiply, for example, by 0.8 for Forex pairs. That single number is your minimum stop distance for that specific market on that specific day. Mistake number 2. The multiplier changes by asset class. Forex gets 0.8 times ATR, but commodities, indices, and stocks need wider protection because they move with more force. I use 1 to 3 times ATR depending on backtests for each market. So if you trade multiple asset classes with the same multiplier, you are underprotecting one and overprotecting the other. Every time your tight stop loss triggers and you re-enter the same trade, your broker collects the spread twice. The market charges an admission. Pay the price or don't enter the trade. So now you are measuring distance based on each market's volatility. But the right distance placed at the wrong reference point on the chart is protection that is anchored to a level the market does not care about. 2 traders place identical ATR stops on the same market, same day. One gets stopped out on a normal pullback and the other rides it to the target. In 1983, Richard Dennis recruited complete beginners off the street and gave them a fully mechanical trading system. They became the turtle traders. Over 4 years, they generated more than $175 million in profits, and their edge was not better entries or better market trading. Every turtle calculated their stop at 2 times the 20-day ATR, and every stop was placed at a structural level the market would have to break through to prove the trade wrong. Soybeans got a completely different stop loss than treasury bonds because the ATR was different, but the anchor point was always the same kind of reference. That is, a level the market had already proved it respected. Every time you anchor your stop to an arbitrary line instead of a structural level, your protection sits on a reference point the market does not respect. And the fourth error is the mirror image. Instead of anchoring too close, you move it too close after entry. And when price moves slightly in your favor, you tell yourself, I'm up a little, let me just lock in, break even, so that I can't lose on this one. The market pulls back, clips that break-even stop loss, and runs to your original target. I call this the break-even trap. You removed yourself from a winning trade. Mistake number 3, Always place your stop beyond the structural level the market needs to break to prove your trade wrong. For a pin bar, that means beyond the tail. For an inside bar, it needs it beyond the outer mother bar, not the inner one. On a pullback entry strategy, place it beyond the nearest swing high or swing low. So if your stop is sitting at a random distance from entry rather than a structural level, it's not protecting anything. For mistake number 4, I never move my stop loss to break even. Never close a trade early based on trading comfort. Comfort is how winning trades become zeros. Those 4 errors live on your chart. You can see them and measure them. But the 5th one never shows up on any chart. You've measured the ATR, matched the multiplier, anchored to structure, and committed to no break-even trades. But the 5th error fires after all 4 are fixed, and it never shows up on any chart. Now, the reason you are making these errors is different from the reason the trader next to you was making. One trader uses fixed stops because nobody showed them a better method. Another uses them because tight stops are an anxiety response wearing a technical mask. Same error, completely different root cause. And misdiagnosing yours means the fix that works for someone else speeds up your trading losses. That's what the free 3-minute diagnostic quiz in the description identifies before you spend months on the wrong one. It's called Why Am I Still Losing Money Trading? Take it today using the link found below in the description. Every error so far was set before the trade went live, but this one fires after. You can have the perfect ATR distance, the correct structure, and the right multiplier, and still lose because of what your hands do between placement and the close. On the 25th of January 2021, I placed an inside bar trade on the pound Japanese yen. 3 bars had formed, 2 of them mother bars, and my system said the stop loss belongs beyond the main outer mother bar. But looking at the chart that morning, the outer bar felt too far and the stop loss distance looked too wide. So I set my stop loss based on the inner mother bar instead. I zoomed in one more time to make sure that it looked right. I can still remember the logic I used. The inner bar is close enough to the structure. The market probably won't pull back this far. I was negotiating with the chart, trying to save a few pips of distance by picking a tighter reference point that felt reasonable but wasn't in my rules. And the market stopped me out. And then it moved exactly where I predicted. If I had placed the stop loss where the system told me to place it, the trade would have been a winner. That override cost me a winning trade, the kind that you keep replaying. And the thing that made it so quiet and so dangerous is that it did not feel like an override at all. It felt like discretion, like I was being smart about my placement. But discretion with an open chart is just emotion with a better vocabulary. I call this the override tax. Every time you manually adjust your stop loss outside of your trading plan, you are paying an invisible tax to your emotions. And the receipt looks like a normal loss in your trading journal. That the trade went against you. Nothing unusual on paper. But the truth is, your system stop loss would have held and your hands moved it. Before every trade, I ran 5 yes or no questions, and they cover all the 5 errors in one pass. Question 1, is my stop loss distance based on the average true range for this specific market today? Yes or no? Question 2, am I using the correct average true range multiplier for this asset class? 0.8 for Forex, 1 to 3 times for everything else? Yes or no? Question 3, is my stop loss beyond the correct structural level? The outer bar, the swing high, the swing low? Yes or no? That's the question most traders fail. Question 4, have I committed to not moving this stop loss to break even if it is in profit? Yes or no? Question 5. Once this trade is live, will I make 0 manual changes to the stop loss? Yes or no? 5 binary questions that take less than 60 seconds, and if any answer is no, the trade does not go on. Manual trading intervention mid-trade is raw emotion wearing a lab coat. I never touch my stop losses after entry. You answer all 5 questions before the trade is live, before you have an open profit or loss on the screen corrupting your trading judgment. The trader who planned the trade at 6 a.m. is not the same person at 3 p.m. after a bad day at work, sitting there thinking, just move the stop, it's only a few pips. The checklist locks in the 6 a.m. decisions before the 3 p.m. version can undo them. One condition makes this checklist tell you to walk away. When the average true range stop distance is so wide that your reward to risk drops below 2 to 1, skip the trade. The question on this checklist most traders hesitate on is question 3. Knowing your stop loss should sit beyond a structural level and knowing how to identify that level on a live chart are 2 different trading skills. So print the 5 questions tonight, put them next to your screen, and run the checklist on the last trade that you took and score it. That's the first time you will see exactly which of these 5 errors has been in your trading routine. That's when you stop donating to market noise and start keeping the trades that were already yours. The best stop loss is the one that your hands never touch. So watch this video next, where I break down the exact maths that places your stop loss outside of the noise zone for any market that you trade. See you in that video.